Welcome to the Three Edge Week in Review for the week of March 14th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at Three Edge Asset Management. Today, Eric and I will be discussing the move this past week by the Federal Reserve to raise short-term interest rates and how our proprietary research model helps us to better understand the impact of Fed policy on different asset classes. We'll also discuss the potential for the U.S. economy to enter a period of stagflation. This past Wednesday, the Federal Open Market Committee of the Federal Reserve increased short-term interest rates by 0.25%, or 25 basis points, in their effort to combat inflation, which is currently running at levels not seen in 4 decades. Last week's action was the first time the Fed has increased rates since 2018. In addition, the Fed also indicated that the most likely scenario for monetary policy for the remainder of the year would be a series of additional 25 basis point rate increases, one at each of the 6 remaining FOMC meetings in 2022. Fed Chair Powell also kept the door open to raising interest rates by increments larger than a quarter point should that become necessary. And interestingly, a few Fed governors have already recently expressed their desire to see the Fed raise the funds rate by 50 basis points in 25 instead of 25 to get closer to the normal rate. One thing is for sure, and that is after Wednesday's FOMC meeting, it is clear now that the Fed has acknowledged that inflation is going to be higher for longer and less transitory than they were anticipating just a few months ago. And no doubt the one thing that has changed the most since the last FOMC meeting is the war between Russia and Ukraine. And in his remarks last week, Fed Chair Powell, he acknowledged the geopolitical uncertainty clouding the Fed's outlook and admitted that the conflict in Ukraine is likely to put additional upward pressure on inflation and weigh on economic activity. And usually the Fed actually doesn't make policy decisions in periods where there's a conflict, but the rate of inflation and the really strong labor market have prompted the Fed to move even with the war in Ukraine raging. So let me bring Eric into the conversation. And Eric, with the Fed taking action to combat inflation by raising short-term interest rates, I think it would be interesting to share how our model research incorporates the potential for rising rates and in particular about the shape of the yield curve.
Yeah, there's a lot to unpack here. We'll go through 3 major areas in which the model incorporates these types of things. So first, it's worth noting that, at Three Edge, our investment committee routinely makes assumptions about the path of interest rates in the short term, as dictated by the world's major central banks. And we infuse these predictions into our T-bill modeling for each major economy. In the case of the US, for example, we have had a 25 basis point rate hike for March priced in for some time already. In addition, we've also had additional 25 basis point hikes in for each successive meeting. And this then flows throughout the model and brings up the next point. As you and Steve have touched on in a prior video, we've constructed our own global yield curve measures, which are built using short and long-term interest rates. These in turn are then used in rate of change factors, with what we call our global yield curve change factors, to assess the economic growth prospects for an economy. And we also independently look at the rate of change of these short-term interest rates themselves. So there's a lot going on there. And then moving on, so you were talking about inflation as well. And so with regards to inflation, we examine that through 2 lenses. The CPI, which is a government-furnished statistic and lagged by its very nature and sometimes even restated, shown here in blue, and the other is the market's inflation expectation, which is measured by comparing the difference between the prevailing nominal treasury yield with the yield on TIPS, or treasury inflation protected securities, which provide a measure of real yields. Therefore, this difference is the market's inflation measure, shown in orange. You can see that the market's implied average inflation rate, also referred to as this break-even inflation rate, tends to move much more quietly or slowly than the prevailing CPI value, as this is an estimate of what the market really believes inflation will average over the next 10 years. Currently, the break-even has barely budged relative to the sharp upward move we've seen in CPI. Now it's 7.9%, that 40-year high that you referenced. Only now in March might we be seeing the first signs that market participants are actually, starting to believe inflation is actually going up. Wells Fargo, for example, is estimating that CPI will average 7.5% for the remainder of the year. And
Okay.
we've seen other industry analysts, suggesting inflation may spike close up to 10% in the next few months as a result of increases in fuel prices. And we're seeing the 10-year break-even inflation rate pop up near 3%, which is an all-time high for that particular statistic. And the 5-year break-even rate has popped up to 3.5. So things are moving up. The market is finally starting to believe in inflation is here, which it certainly is.
Excellent, excellent. So now I think it's good. Let's take a look at another topic that Steve and I had discussed previously, which was the topic of stagflation. And we had raised this topic last year, and now I'm seeing it much more in the financial press, these discussions around the potential of a stagflationary environment. And one thing I think is important is that I mentioned earlier, and that is that during Fed Chair Powell's remarks, he acknowledged that the war between Russia and Ukraine was putting additional upward pressure on inflation and weighing on that economic activity. And that statement to me is very important, just simply based on the definition of stagflation, which we have here, which is stagflation is an economic condition that's caused by rising prices and higher inflation, along with slowing economic growth, which can lead to higher unemployment. And just the fact that Fed Chair Powell mentioned the conflict in Ukraine and how it's likely to increase inflation and slow the economy is important because it signals the Fed is also concerned about the prospects for stagflation in the future. And we haven't seen this. I mean, the last time we experienced stagflation was back in the 70s during the OPEC oil embargo. But if we have elevated, fuel prices for a foreseeable future, that could slow consumer spending. And in this country, consumer spending is very, very important. And if people are not spending on other things because they're taking so much of their paycheck to fill their gas tank, that could certainly tip the economy, have it slow, and maybe even push it into recession. So, with the risk of stagflation now more prominent, how might our three-edge model, actually identify the potential for stagflation down the road?
Yeah, well, the model can definitely help us identify these periods. As you just defined it, you're really asking, how does the model identify periods marked by both the prospects for slower growth as well as rising and or elevated inflation, and how might it do that? So the rising inflation is already here. We're seeing that in the prices of goods and services. A central bank like the Fed, in turn, raises rates to combat this inflation. Though if they're too aggressive in their response, they run the risk of slowing growth and causing rising unemployment. At the same time, the rising inflation on its own may stop people consuming as well, which can also slow growth. Within the model, we see inflationary environments marked in a few places. First, for each macro economy we research, we have an inflation deviation factor, which penalizes economies with excessively high or low inflation that is outside of a well-behaved band, particularly if the inflation is heading in the wrong direction. For example, high inflation getting even higher. And this factor also rewards economies for inflation that is heading in the right direction. For example, like a high inflation that is coming back into the so-called normal range.
Mhm.
Also within the behavioral element of our equity modeling, we have the ability to identify those economies whose inflation has risen too far in too compressed a time frame, a condition that when present may suggest a rather aggressive or hawkish central bank response, which in the short term may lead to a sell-off in risk assets like equities. We also find inflation, both the government furnished CPI as well as the inflationary expectations that we just discussed, weaving into the gold and commodities models as well. With regard to the slower growth side of stagflation, we've already noted the inflation deviation factor, which may be a positive or negative driver towards the overall attractiveness of equities. But we'll also pick up on growth expectations through several of the other economic factors in the model, like our yield curve measure, the rate of change of this yield curve measure, the yield curve, that's the yield curve change, as we call it, as well as various measures of credit spreads, including investment grade and high yield spread changes.
Excellent. Great. So one more question then following up to that. So if we are seeing those signals, if the model would be picking up those signals, then what would be the asset classes that the model would favor in that environment? Because it
Yeah,
doesn't sound
well,
like an easy environment for investors.
no, not the traditional asset classes of equities and bonds may not perform particularly well. As our seasons of the market chart shows, spring is given way to summer where inflation heats up and real assets tend to outperform like gold and commodities. We're certainly seeing that. The question is, then what exactly when do we head into the fall? Or might we swing back towards the spring? An unusual but certainly possible outcome. And then, it's really the outcome of the Russia's war with Ukraine alongside the world's major central banks' interest rate decisions that will likely heavily influence the timing of that. So, in the meantime, beyond gold and commodities, we also favor TIPS. That is inflation protected bonds. TIPS are indexed to inflation, so the principal amount increases as inflation increases. The fixed coupon rate pays on this adjusted principal balance twice per year.
Right.
And beyond that, we favor value oriented or higher quality equities. And we favor cash as dry powder. During volatile times like this, being nimble and tactical can allow one to attempt to catch bear market rallies to further enhance returns when the conditions are right.
Excellent. Great. Well, very good. Thank you, Eric. We will be closely monitoring all those developments in the capital markets in the coming months. And so that will do it for Eric and me. Steve Cucchiaro and I will be back next week for another edition of the Three Edge Week in Review. And remember, all our videos are available on our Three Edge YouTube channel. In addition, all our videos and written commentaries are always available on our website at 3edgeam.com. So until next week, on behalf of Eric and everyone here at Three Edge, thanks for listening.